In 2024, the United States was shipping an impressive 166,000 barrels of oil every single day to China. This steady flow of crude symbolized a thriving trade relationship between two of the world's largest economies. Then, without warning, it stopped. By the spring of 2025, that number had plummeted to nearly zero. No tankers arrived, no new orders were placed, and the once bustling terminals fell eerily quiet. The silence from China was deafening, a sudden, jarring end to what had been a booming partnership. The abruptness left everyone guessing. There was no press conference, no official statement from Beijing. Just a void, as if the world's second-largest economy had simply vanished from the oil market overnight. American oil producers were left in shock, watching their biggest customer disappear without explanation. The uncertainty rippled through the industry. This wasn't just a typical market fluctuation. It was a calculated, strategic move by China, executed with precision and secrecy. The oil flow, once constant and reliable, was turned off like a faucet, swift, final, and absolute. In Houston and Corpus Christi, disbelief and confusion spread among workers and executives alike. The ports, once alive with activity, now stood still. Oil traders found their phones silent, their screens blank, and the entire logistical chain ground to a halt. Deals evaporated overnight. The American shale boom had thrived on the promise of endless demand, with China serving as the engine that kept it running strong. Now, that engine was off, leaving a gaping void in the global oil market and in American industry. This was no accident. It was a deliberate, calculated decision by China's government, signaling a major shift in global energy politics. The message was unmistakable. China no longer needed American oil, and it was ready to chart its own course. The implications were profound, challenging America's long-standing role as an energy superpower and raising urgent questions about the future. The silence wasn't just an absence of trade. It marked a new reality, one that would rewrite the rules of global energy for years to come. In a move that sent ripples through the global energy market, China quietly severed its energy connection with the United States. This was done with a subtle, yet impactful 10% tariff on American crude oil imports. Unlike a loud declaration of a trade war, this was a calculated, targeted measure focused solely on U.S. crude oil, sending a clear but quiet message. For Chinese refiners, the new tariff made American oil instantly uncompetitive, pushing them to seek alternative suppliers. The tariff functioned as a silent embargo, effectively pricing U.S. producers out of one of their largest markets without any formal announcement. This was economic statecraft at its finest, strategic, quiet, and highly effective. By making American oil more expensive, China sidestepped the need for a formal ban, maintaining plausible deniability on the world stage. State-owned giants like Sinopec and PetroChina quickly stopped placing new orders, shifting their focus to other global suppliers. The tariff became an invisible wall, abruptly halting a billion-dollar trade that had been growing steadily. This move demonstrated how economic levers can quietly reroute global supply chains, forcing companies to adapt overnight. China managed to reduce its energy dependence on a strategic rival, all while avoiding direct diplomatic fallout or public confrontation. In Washington, policymakers and oil executives found themselves with little recourse. After all, the tariff was well within China's rights under international trade rules. The underlying message was unmistakable. Trade relationships are about power, leverage, and influence, not just the exchange of goods. The impact on the U.S. energy industry was immediate and severe, with exports plummeting and workers left in limbo. The tariff signaled to the world that the U.S. was no longer a desirable or reliable partner for China's energy needs. Ultimately, it was a wake-up call for both nations, revealing the true fragility and complexity of global interdependence in the modern era. As American oil doors closed, others opened wide for China. China had prepared, building a network of alternative suppliers. New contracts with Russia, Iran, Saudi Arabia, and the UAE were inked. These were strategic partnerships, securing China's energy future. Russian oil became crucial, and embargoed Iranian crude found a buyer. Many contracts were settled in yuan, challenging the petrodollar. This shift allowed bypassing the U.S. financial system. Expanded Russian pipelines ensured a steady land-based supply. Deals with Gulf states involved Chinese investment in refineries. China became a core partner in the global energy landscape. This realignment was about more than oil. It reordered global alliances. China is transforming its energy demand with ambitious policies. Electric vehicles are replacing combustion engines in major cities. Government support made China the EV leader, reducing oil demand. The trucking industry is shifting from diesel to LNG. LNG trucks reduce oil reliance and combat air pollution. High-speed rail connects major cities, reducing jet fuel and gasoline use. These changes are part of a strategy for energy security and environmental goals. China's demand-side management gives it leverage in global oil markets. China's pivot hit America's energy export infrastructure hard. Gulf Coast ports, expanded for the shale boom, faced excess capacity. Terminals for VLCCs destined for Asia were underutilized. Shipping channels grew quieter, and tanker sightings became rare. The infrastructure seemed oversized and underutilized. Reduced pipeline flows led to a glut of oil on the Gulf Coast. This surplus depressed prices and forced producers to scale back. The economic impact on local communities was significant. The promised boom turned into a potential bust. The shale revolution made the U.S. a major exporter, reliant on foreign buyers. China's withdrawal showed the need for reliable markets. For decades, the global energy trade has depended heavily on the U.S. dollar, making it the backbone of international oil transactions and giving the United States a unique position of influence. This petrodollar system granted the U.S. immense economic and geopolitical power, allowing it to shape global markets and policies. Now, China's bold move to purchase oil in yuan is directly challenging this long-standing arrangement, signaling a significant shift in global finance. By signing yuan-denominated contracts with major oil exporters like Russia and Iran, China is helping to build an alternative financial system outside of U.S. control. This new system offers participating countries a degree of insulation from U.S. sanctions, making it increasingly appealing to those seeking financial independence. As China reduces its reliance on the dollar for oil purchases, the U.S. system grows weaker, and its influence over global energy markets begins to wane. Every oil transaction conducted in a currency other than the dollar chips away at global demand for the greenback, slowly shifting the balance of power. Over time, this trend could erode the U.S.'s financial privilege, reducing its ability to dictate terms in the world economy. Such a shift challenges the economic order established after World War II, which has long favored the United States and its allies. The U.S.'s global power is deeply rooted in the dominance of its currency, which has served as the world's primary reserve for decades. But as China's alternative system grows, it steadily chips away at American financial power and influence. The battle for control over energy markets is now also a battle for financial dominance, with far-reaching consequences for the global economy. The rise of the petro-yuan is a slow but steady process, gradually reshaping the landscape of international trade. For countries wary of U.S. sanctions and eager for more autonomy, this alternative system is becoming increasingly attractive and viable. Ultimately, the future of energy is inseparable from the future of money, as nations compete for both resources and financial supremacy on the world stage. China's energy pivot is part of a larger global narrative. While the U.S. focused on internal debates, others rewired the global system. Nations are building new alliances and trade routes. This is a multipolar world, with energy as the primary currency. China's strategy enhances its power through economic dependencies. It reshapes geopolitical alignments across Eurasia. The new map of influence is drawn along pipeline routes. Countries see alternatives to the Western-led order. The unipolar moment is over. The U.S. is no longer the only power. The world is being remade, and the U.S. must decide its role. The loss of the Chinese oil market challenges American power. Energy dominance is about controlling markets and supply chains. The shale boom gave the U.S. a tool, but China holds its own. This demands a recalibration of U.S. energy strategy. Energy independence is not the same as energy security. Security comes from diverse and reliable customers. Future policy must focus on diversifying export markets. The challenge to the petrodollar is a direct threat. The U.S. must strengthen the dollar through economic dynamism. Allies must uphold a rules-based financial order. The events of 2025 are a wake-up call. Future battles will be over supply chains and currency dominance. American power must be actively maintained. The silence from Chinese ports was a message. The U.S. must choose to adapt or be shaped by the new reality.